Are you making sound investments in real estate and things that are going to appreciate and pay income and all the things that you would want out of a good investment? Or am I just doing that because someone told me real estate's good?
Every entrepreneur I meet thinks that they understand these real estate tax strategies. They buy a building, throw in an entity, take some depreciation, and oftentimes they're leaving a lot of money on the table because they don't understand Section 469.
But they don't have the documentation or the proof that they actually qualify. And boy, that's a ripe target for the IRS if you get audited.
As we think through the future of family offices, fractional family offices, multifamily offices, how do you incorporate AI and provide more services?
It's who has the wisdom about how to bring together all these pieces and who can execute it and get it done in the way that's custom for that individual entrepreneur.
Jim, welcome back to the Make Rich Real podcast.
Thanks, Bryce. Good to be here.
I'm excited. We got a really good docket today, and you look good.
Thank you.
You don't look old.
This is going to be a theme of our podcast, just how old do I look?
I love it. Well, today we've got a nice docket, so we're going to go into Wayfair versus South Dakota. We're going to talk sales taxes, income tax nexus, a lot of issues that entrepreneurs are facing all the time and constantly have questions about. And then we're going to jump into real estate and the value from a tax perspective and talk through Section 469 of the tax code, active versus passive, and then also why a lot of our operating business owners want to own the real estate that their operating businesses running from, and why there's a lot of tax advantages to that. So that's what we got on the docket. A lot of good stuff here.
Sounds like a good potpourri of amazing stuff.
I don't know what that word means, so I'm just going to keep going and move on here. So 2018 Supreme Court case, South Dakota versus Wayfair changed really everything about how states can now reach into every single business and demand sales tax, even if the state has no physical presence there. So that was 2018. We're here 7 years later, and most business owners still aren't fully compliant, don't know how this works, and states are getting more aggressive. So just to back up and to tee this up, really the law heading into 2018, dating back to the really reaffirmed in the Quill versus North Dakota tax court, was that if there wasn't a physical presence in that state, you couldn't acquire or get sales taxes essentially. But then the Supreme Court ruled 5-4 in favor of in favor of South Dakota versus Wayfair, which now opened the door where states could impose sales tax collection based purely on economic activity. And so South Dakota was the first one to set this law that said, if you're an out-of-state seller and you do over $100,000 in sales or 200 transactions in that state, you now must withhold sales taxes to anything sold in the state of South Dakota. Of course, what happens then, every single state looks at this as a money grab. So then all of them say, oh, we're on board with this too. And now here we are 7 years later, there's 50 different states and there's practically 50 different sets of rules. So it's a big compliance nightmare for business owners selling any type of product.
Yeah, it's been, to say it's a pain is an understatement. And really, with all the e-commerce that goes on, this is just a nightmare. And you're right, a lot of entrepreneurs don't even know. You and I have met entrepreneurs that do business in multiple states and they're like, what? I've never heard of that. That's a problem.
Yep. So most states now are at a $100,000 sales threshold. And that means that if you do over $100,000 of sales, you now are required to really withhold and remit sales taxes into that state. California and Texas have a $500,000 sales threshold. New York, $500,000 in sales and 100 separate transactions. And so then there's different ways of how you measure this. Is it based off of a calendar year? Is it trailing 12 months? And when you look at the different state and local tax jurisdictions, there are over 12,000 different state and city sales tax jurisdictions. So it's very, very hard to be completely compliant because of all the complexity here. And then we're going to show a chart here that shows the 31 states with that tax internet sellers without physical presence. So there's going to be, this is just something that the tax foundation put together here. So one thing that I think is also overlooked, that we're talking sales tax, is that there's also income tax nexus that can be derived too. And this is another thing that a lot of entrepreneurs are also not compliant with, which is, okay, maybe I'm not selling into that different state, but oftentimes if you have a certain amount of sales thresholds, usually $500,000 or more, $50,000 or more of property or $50,000 in payroll, you oftentimes need to then pay state income taxes in that state. And so if you're a pass-through business, which most of our clients are, with S Corps or partnerships, the business, you file all of that profit flows through to your 1040, and then you need to file an state income tax return in all of these different states. So a rough rule of thumb that we like to say is if you have an employee, you have income tax nexus. So now you're at a stage where sales tax nexus, income tax nexus just makes this so hard to be compliant with across the board.
Super complicated, and that's why a lot of people use payroll services when they have employees in different states. They use different programs and companies to try to keep this straight, but it is a nightmare. I remember one time California came after me years ago saying that I owed California taxes, and we've never had an employee in California. We have a rule that we don't hire in California because it's very anti-employers in California. And yet my accountant sent a letter telling them to pound sand, and they went away. But they were trying to come after me for California income taxes. And I've never lived in California. I've always lived in Arizona. It's just a bizarre thing, but it's frustrating to entrepreneurs.
Yeah. And as you mentioned, so software is now caught up to the place where, I remember in 2018 when that case went down, really, and then COVID really just skyrocketed online sales, obviously. But now with TaxJar and Avalara are the two biggest best-in-class solutions. And now they have pure API integrations that can be built into your Shopify account. Amazon now has it built onto the FBA system. So there's a lot of software that's been built up around this. You can kind of outsource it where they'll automatically withhold the sales taxes and remit it for you, akin to what a payroll provider like an ADP or AdjustWorks or Augusto will do on the payroll side. So those are the two big ones that will track sales against every state's economic nexus rules. They'll integrate with your e-commerce platforms, as I mentioned, and then really automate the filing. So that's helped from a compliance perspective. But one thing that I think that we're starting to see more of, I shouldn't say think, that I know we're starting to see more of is states coming after their cut. And so California is known to be very aggressive. Their Department of Tax and Fee Administration has really gone after Amazon, because what they would do is they subpoenaed Amazon, and if Amazon stored any of your warehouse in California, you now potentially trigger Nexus. So even if you're not hitting the sales thresholds in California, your physical property, if over a certain amount of money, is sitting in California because Amazon put it there, not because you put it there, you now have a California income tax liability.
Wow. Leave it to California.
They need to make some money, I guess, right? And then the big thing, right, if you're California, really what they're looking to get at too is not just income and sales tax, but then foreign filing fees, because then you need to register to do business in California as a foreign filed LLC. That's an $800 a year renewal that's going through the California Franchise Tax Board,
and it goes up too based on revenue.
Yeah, right, exactly.
It's not based on profit.
Yeah,
you could make no profit and you'd still owe that foreign LLC tax to the government.
Yep.
Bizarre.
And so when I was looking at the tax foundation, sales taxes, which were really small, now account for about 30% of all state tax revenue.
Wow.
Second only to individual income taxes, which is at 38%. So it is a huge driver of this. And it's bigger for obviously states that don't have income taxes. So Texas derives 74% of its tax revenue from sales taxes. Obviously Texas has high property taxes too, which makes up the bulk of the rest of that. South Dakota, again, tax-free state, is at 65%. Tennessee over 60%. So these states need that sales tax revenue, hence why the enforcement is very aggressive now.
Yeah. What are you going to do? New taxes all the time.
Taxes. So a lot of issues here with entrepreneurs. That's one good thing about providing a service, is that we don't have to deal with all of those sales taxes and those Nexus requirements.
That is true.
Otherwise, it
and we don't have to deal with inventory and some of the other things that are challenging to a business.
Yep. But it is also very hard to scale a service-based business because you scale off of people, which everyone knows people are not the most scalable.
You're very right on that. We've figured that out.
All right, let's talk through a last angle here of sales tax and why is tax compliance important. This is a huge M&A due diligence item. And so sales tax is one of the most frequent sources of material exposure uncovered during due diligence. And I know, talking to entrepreneurs all day, every day, a lot of entrepreneurs are not fully compliant. If you were to say that starting going back to that 2018 date when the Wayfair lost to South Dakota, oftentimes what happens is that an entrepreneur kind of decides at a certain point they want to start becoming compliant, and they'll start remitting sales taxes once they get the system and the platform set up. But then the risk and kind of the game theory is, well, is the state now going to say, well, where's my money from all these previous years? And are they going to start sending letters, send an audit, and go after you? And right, if you haven't filed the returns, and there is no statute of limitations. So when you're looking at M&A deals, there's going to be reps and warranties that are going to be specifically baked in here, and some liability, because if the states come after this entity after you sell it, then obviously the new buyer is going to say, hey, this was your problem. You're on the hook for that.
Yeah. I think the lesson there is, when you're running a business, you want to run it as clean as possible, because you think like, oh, well, I don't have to pay that. I don't have to worry about that. I don't have to have my P&L lined up, my books and records, all that stuff. If you ever sell your company, all that stuff can come back to bite you. And definitely, as you said, from an M&A angle, if your buyer sees a skeleton in the closet that could come out to get them, even if it's a low risk, they're going to hit you on the price over that, because they're going to say, hey, this could happen because you didn't do what you should have done, years ago.
Yep. Okay. So we're going to transition here, and we're going to transition from state sales taxes to federal income taxes. Specifically, something I see entrepreneurs get wrong all the time. I was just talking to an entrepreneur 2 weeks ago looking to buy real estate, and was telling me all the tax benefits that he was going to get. And I hated breaking it to him, but he was going to get no tax benefits from it, because people just hear, oh, real estate tax benefits, but there's a lot more that goes into it. So every entrepreneur I meet thinks that they understand these real estate tax strategies. They buy a building, throw in an entity, take some depreciation, and oftentimes they're leaving a lot of money on the table because they don't understand Section 469 and active versus passive when it comes to real estate. So, Jim, I know this is a space, Section 469, fond to your heart. Break down active versus passive, and what this means when it comes to real estate investments.
Yeah, well, as you said, entrepreneurs think that, oh, you know what, I get depreciation from real estate. So if I do a cost segregation study, I get a bunch of depreciation, then it offsets my income. Depends what kind of income you have. So if you have active income from a business, and let's just assume because I know we're going to cover it in a second about, what you can do being a real estate professional, but let's say you have an active business unrelated to real estate. You buy a building to run your business out of, you cost seg that, and you get this huge depreciation write-off. And you think, man, that's going to wipe out a bunch of taxes. And to your point, it doesn't wipe out your taxes, because generally depreciation from real estate offsets passive income, not active income. And so it doesn't offset the active income from your business. So that's a big gotcha there. And there's, again, some ways around this. And one thing is the Section 469, where you can do this thing called grouping, and group together the business and the real estate depreciation in a way. It's a one-time election, has to happen when you buy the building, and then you can actually unlock that depreciation to create massive tax benefits. So anything I missed there that you want to add to that?
No, yeah, we're going to talk through the 469-4 election, which is exactly what you talked about, and that's what a lot of the entrepreneurs who are tax efficient are doing. But again, going back to 1986, when Reagan rewrote the tax code, it essentially said, by definition, if you are investing in real estate, that is passive unless you can overcome a certain level of threshold to make it active. And that's what's called the qualified real estate professional designation or status underneath 469C7B. So in order to overcome real estate being passive, you need to really do three different things. First thing is you need to spend at least 750 hours of services in a real estate trader business. The second thing is more than 50% or half of your time must be in a real estate trader business. So this prevents the people who are working full-time jobs from then spending another 750 hours, as they allege, on top of it, which means they're working, 100 hours a week. And then the last thing is you need to materially participate in the rental activities. So that's generally 100 hours and more than anybody else, or 500 more hours. Now, you can aggregate together material participation with the 469-9 election to group multiple activities together. So for example, if you own 10 different properties, you can't spend 500 hours on each property. You aggregate those together, and then it's the basket. So if you pass these three tests, then what happens is all of that real estate activity flips from passive to active. But the thing entrepreneurs don't understand is that it defaults to passive. So unless you beat this hurdle, which is not easy, all of those losses are passive losses.
And we've seen sometimes where an entrepreneur can have the spouse that qualifies. What I see most often, though, is that they claim this, but they don't have the documentation or the proof that they actually qualify. And boy, that's a ripe target for the IRS if you get audited.
Yep, you want an hour tracking log. That is something that we definitely make sure that we help our clients put together there. So exception number 2 here. So like you mentioned, the 469-4 grouping election. And so this is really where, to your point, if you have an operating business and you have real estate and you're running your operating business out of your real estate, you can group these two things together. And then this allows you to take the depreciation or losses from the rental property or from the actual physical property and use that to offset and really aggregate together and offset income from your active trader business. So in order to...
Otherwise, it gets trapped, and it could be trapped in there for years and years and years.
Yep. Yeah. And to your point, they need to be aggregated together as an appropriate economic unit, and they can be grouped if the rental activity is insubstantial, if the trader business activity is insubstantial in relation to the rental activity, or each owner of the trader business has the same proportionate ownership interest. And that's the threshold that most entrepreneurs are going to hit. So again, you own 100% of your business, you own 100% of this real estate, your business is leasing the real estate. Now you can aggregate these two things together. And so then what you're going to want to do is write, this is actually like a written statement. It's not a check the box, but it's a written statement that the CPA should make, on your tax return, letting the IRS know that you're aggregating these two together and referencing the section of the code.
Yeah, it's one we've seen missed a lot. And when you can get it, boy, it's powerful.
Yep, it's powerful. And it is generally a binding election, so you can't undo it unless there's a material change, which is difficult burden. So that being said, one other issue we see when it comes to owning real estate and having an operating business is that some people will buy the real estate in their S corporation, and that is a huge no-no. So when you're buying real estate, you want it in a separate entity that helps from a liability perspective, and you always want it in an LLC. You never want to make the S election. There's really 3 main reasons. The first is that you don't get debt basis in an S corporation, and so you're only allowed to take losses up to your basis, which is really like how much money you've put into that business. Now, in an S corporation, you don't get basis for taking on debt, but in a LLC, you do get basis for taking on debt. So that allows you essentially to write off more losses if you're not in an S corporation because you have more basis. Second thing is you have no flexibility moving assets out of an S corporation. So when you move any type of appreciated asset out of an S corporation, it's a deemed distribution, and that triggers capital gain taxes. So even if I want to move it out of my S corporation to me as an individual, and I am the same, I own the S corp, it doesn't matter. When an appreciated asset leaves the S corporation, you pay capital gain taxes on the appreciated.
And we've seen a lot of problems with that because it was incorrectly put in an S corp, but to get it out of the S corp is a triggering event for taxes.
Yep, exactly. So it's hard to get that cleaned up too.
Right.
And then the last thing too is when you do a transaction, generally the buyer, private equity especially, is not going to want the real estate. And so if it's all tucked in underneath one entity, it's a little bit harder to unwind that. Whereas if it's an operating business and then it's the real estate, then oftentimes what happens is they'll buy the operating business and you can lock in a long-term lease with the new buyer, and now you actually have a lot of passive cash flow. So again, always hold that real estate in a separate LLC, but never make the S election in that LLC.
Good advice.
All right, and then this with the 100% bonus depreciation, right? And you mentioned cost segs. Just to reiterate, cost segs allows an engineer to go in and break down the building, which a commercial building is normally depreciated over 39 years. But an engineer comes in and says, well, the cabinets, the flooring, the HVAC, some of these are improvements. Some of these are going to be depreciated over 5 years or 10 years or 15 years. Well, anything with a 20-year useful life or less can get bonus depreciated after the one big beautiful bill. So as a rough rule of thumb, around 30% of the value of the building, which isn't necessarily fair market value because you have land in that equation too, but around maybe 30% of the building can generally, it depends on the type of building, be cost segged or written off day one. And so again, that's cost seg combined with bonus depreciation. That's how we're stacking strategies to accelerate some of the deductions here.
Yeah, it's a powerful thing that the one big beautiful bill put back into play.
Okay, so let's go through a case study here of an HVAC owner and how he put $370,000 plus in his pocket year one through doing this 469-4 aggregation, combining and really buying real estate and then having his HVAC company run out of there. So setup here, the HVAC business is doing $5 million a year of taxable income, structured as an S Corp, 100% owner, no state income taxes, but paying 37% at the federal level. And so what he decided to do was buy some land for $2 million. Really, it's going to be like a shop and a yard, and then about $2 million of shop construction and yard improvements, paving, fences, etc. So the total investment's $4 million. $2 million is the dirt, $2 million is the actual building. Now that real estate acquisition is going to all be done in a separate LLC. So then what you do is once this thing is built out, you now have this $4 million asset. You now do a cost segregation study, and we're going to put a table up here.
Now, would you put that in an S Corp?
You would not put that in an S Corp.
Okay, that's what I thought. Just following along.
Put that property in an LLC, you do a cost segregation, and you're going to break that $2 million build into the sub-ingredients and look to accelerate some of the bonus depreciation. So here, let's assume that the bonus depreciation amount is $1 million. That can be written off. So now you can take, because we aggregated this business with the rent or with the real estate property that the business is being run out of, you aggregate those together. So that $1 million tax loss, not a cash loss, but tax loss from depreciation can be used to offset part of your $5 million of business profit.
Yeah. And that comes out to 370 grand.
370 grand. Yep. Because if you go from $5 million of profit to $4 million of profit, it saves you $1 million. $1 million times a 37% marginal tax bracket, $370,000.
That's a good day work right there.
It's a good day of work.
Yeah.
All right. Well, then the last thing I want to talk through about this, and we kind of touched on this already, but how oftentimes another back end play for owning real estate with your operating business is when you sell to lock in the new buyer into a 5 or 10 year lease. And then this is a nice cash flow for you as now a landlord instead of a business operator. But break down, and I know, Jim, you've seen this a lot with a lot of sellers of other businesses. Mm-hmm. What's kind of your experience seeing entrepreneurs do this?
Yeah, well, it's a great way to get some ongoing income after the deal is done. And because you own the building separate, that could be part of the deal or it might not be part of the deal. But looping it in, if it's a necessary part of the business, saying, hey, part of the negotiation, make them sign a 20-year lease. I'm just making this up, but a 20-year lease, set the rent levels and the increases over time. And all of a sudden you have that cash flow coming through to you on that building and you still own the building. Pretty powerful concept.
Pretty powerful is right. Okay, so we're going to transition here into the return of bonus depreciation, which I think is one of the biggest catalysts for the real estate investment boom we're really seeing within really data centers right now. And so combined with, we talked about the cost segregation studies, the math really has changed for a lot of business owners, plowing a lot of capital back into the business. So we're going to put a chart up right here that just shows what originally happened in 2017 Tax Cuts and Jobs Act, which was Trump's original tax bill. There was 100% bonus depreciation, and then that was getting stair stepped down. So we were at 80% depreciation in 2023, 60% in 2024, and then in 2025 it was going to be 40%. And then the one big beautiful bill came in, signed into law July 4th, 2025, and then retroactive to January 20th, 2025, and now we're in 2026. It's back to 100% and made permanent. So what this means is that...
And by the way, permanent doesn't mean permanent. It means permanent until another Congress and president changes the law. Sometimes people think that it can't be changed. Yes, it can be changed. It's just hard to change. It's going to stay in force until someone comes in and changes it.
Yep, exactly. And so this is, again, we use the example, I think the easiest example is there's the data center boom that everyone sees going on. Now, the shell of that building normally is written off over 39 years. You can use the cost segregation study to carve that into the ingredients and then maybe write off maybe 30% or so of that in year one. But all of the stuff that's going on the floor, the server racks, the wiring, etc., all of that is immediately deductible or expensable underneath a 100% bonus depreciation. And so Amazon came out with their earnings here from the end of last year, which was kind of the first foray with people seeing the impact of the one big beautiful bill, and their U.S. income tax liability absolutely fell because of the massive reinvestments they're making into the data center. So of course, one side of the aisle is talking about how little taxes Amazon pays and is bemoaning that, but then the other side of the aisle is talking about, well, how much investments these new tax codes have potentially propelled these businesses to make because of the tax benefits, right? And Amazon is one of the biggest CapEx spenders, which is creating a lot of jobs in the different trades as they're building these data centers up in the AI push.
Yeah, it's no doubt. I think they're better off. I mean, we try to tax corporations. It's problematic because corporation can set up anywhere in the world. It's really employees that are where you get your tax revenue. But clearly, this is driving economic results, and I like that. So I'm in favor of that.
Yeah, and one thing that I think is important to note here is that if you are an entrepreneur and you do have a lot of real estate losses and you're either a real estate professional or you're aggregating your business together with your property and you have enough losses to offset all of your business income, remember that you can get capped at how much in losses you can use in the first year to offset other income from W-2 or dividends or interest. And that's underneath Section 461. That's the EBL, or the excess business loss. And that amount, as we were just talking about, has gone down from $626,000 to $512,000. So said another way, you can only use and really $512,000 of business or real estate losses to offset W-2 interest, dividend, or other passive
If you're
income.
a joint filer.
If you're a joint filer.
256 if you're single.
Yep. Cut in half if you're single.
Yeah. Yeah, that was, it's funny that you see the OB3, the One Big Beautiful Bill, and all the tax benefits, but there were also things that were pulled back. We talked about the charitable thing on a recent call, the 0.5% floor, and this, where they lowered the cap from $626,000 for married filing jointly, half that, $313,000, down to the $250,500, which then got indexed. So that's where we come up with the $256 and the $512. But yeah, that limits how much if you're having a loss. Of course, you can carry forward 80% of that for a future year as a NOL.
Yep. So a lot of power in investing in real estate. Just buying real estate and just thinking, hey, I bought this piece of real estate and this property, and now I'm going to get these depreciation losses. There's going to be a rude awakening for those entrepreneurs, is that, yes, you will have losses, but unfortunately those losses are going to be called passive activity losses, PALs, on 8582, and they're going to be sitting there suspended, and you can't use them unless you're a qualified real estate professional or unless you're aggregating with your operating business. So a lot more nuance to these strategies than what they see on TikTok.
Absolutely. And I know there's a lot of people, friends of mine even, who sell real estate education. And one thing that I think some novices think is like, oh, all real estate is great. No, not true. Just like not all stocks are great, not all real estate is great. You have to be a wise investor and not just think about the tax benefits, whether you get them or not, which we just talked about. Not everyone gets them, but also, are you making sound investments in real estate and things that are going to appreciate and pay income and all the things that you would want out of a good investment? Or am I just doing that because someone told me real estate's good? Because often I see people, oh, I'm buying real estate. Oh, that's good. That's good. Well, what kind of real estate are you buying? That's a big differentiator. You still want to be wise and you want to be careful about what you put your money in and not just throw it into stuff because it sounds good.
Yep. Spot on. All right, so we're going to go transition to the fractional family office floor here, and we are just now deploying a tech-enabled estate planning platform that lets us build, visualize, and manage complete estate plan in-house. So this is a really cool tool. I'm really excited about this. It used to take 6 to 8 weeks to build estate docs, and usually our clients would pay maybe $5,000 on average per set. And now we're able to do this at scale using AI, using some of these different systems, and at no cost to our entrepreneurs.
And to be clear, we're not attorneys, we're not drafting the documents, but we're managing the process and making sure that the objectives of the client are getting accomplished through the legal documents.
Yep, exactly. And it's an AI-enabled tech platform that then has counsel in all 50 states that have that approve all of the different documents. So it's how they've been able to do this at scale. Now, this is, I think, as we think through the future of family offices, fractional family offices, multifamily offices, how do you incorporate AI and provide more services? I think that this is really the first foray into exactly that, because in a world where information becomes more and more democratized, really what you need to be doing is more and more execution, because you need to be saving the time and the energy of the entrepreneur, because with ChatGPT, Claude, Grok, Gemini, it's in an information abundant world.
Absolutely. It's who has the wisdom about how to bring together all these pieces and who can execute it and get it done in the way that's custom for that individual entrepreneur. That's the magic.
Yep. And so specifically here within estate planning, are a lot of our entrepreneurs, this is for basic estate docs, so revocable trusts, wills, powers of attorney. At this stage, you can't draft the highly complex and highly customized documents just because obviously it's hard to do that at scale at this stage. But speed is one thing that's important, that oftentimes entrepreneurs need to get certain docs put in place, whether ahead of a big life event, they're having kids maybe for the first time, or they're getting into business with somebody.
About to go to Europe.
About to go to Europe.
Oops, I have no estate docs.
Yep. So speed sometimes matters. And then if you're working with an attorney and it's 6 to 8 weeks and it's a slow process and you're getting interviewed, it's not the most fun experience. But being able to manage this remotely on Zoom calls, guide a client through an interactive portal is really attractive. And then, like I mentioned, there's a lot of cost savings here. That a traditional estate plan is $5,000 if you go through an attorney, and now there's no cost because of the software we pay for all of our clients in our family office. So it's just more cash savings that they get to realize here.
Yeah, it's a tremendous breakthrough for entrepreneurs, for our company. And yeah, it's always interesting. I was just thinking about people going to Europe and saying, I need my documents done. I'm going to Europe. And yet every day they drive on the 101, like here in Phoenix. I'm like, you have way more chance of dying on the 101 than you do going to Europe. But for some reason, I guess that stirs people up. And just like you said, people have a kid and they're like, oh, wow, I better worry about all these things, even though whether you're single or a married couple, you need to worry about those basic estate docs as well, not just when you have a kid.
Yep. And then where we talk about where we're going from with Do Wealth Management, our fractional family office, this allows us to go, pretty deep into the estate planning and get basic docs done for our clients. We're building the bookkeeping. That's going to go live here in a few months. Tax is on our roadmap too, to do in-house tax. And there's a lot of AI happening in tax, which it's about time because that's a very manual process. And so over time, we are essentially following this vision that in the age of AI, we need to make sure we're leveraging the best and brightest in terms of the technology, and then supercharge the right individuals with the wisdom, but start doing more and more for our clients as, again, information is more democratized.
Yeah, and you won't get put out of business by AI. You'll get put out of business by a competitor who uses AI better than you use AI.
Yep. No, yeah. I couldn't agree more. So, all right, Jim, that's what we got for the docket today. Well, as always, we wrap up with biggest takeaways. So what are your biggest takeaways on the stuff we covered today?
I love the grouping, the 469 election. It's just so powerful, and many entrepreneurs buy a building in conjunction with their business, and yet I see this get missed a lot. So that's the one that I would call out.
Yep. I think the biggest thing is just understanding Section 469 and really active and passive. Real estate activities default to passive unless you can overcome the hurdle. So I think that is a big thing that I talk to smart, very successful entrepreneurs all the time who, they just hear things at a superficial level, and then it's like, oh man, this isn't going to work the way you think,
Right.
So it's important that education still does go out, or that, we're talking about how information is democratized. They just need to go a little bit deeper in their ChatGPT queries to get the right answers.
Right, exactly.
Awesome. All right, Jim, good to see you. I'm excited to do this again shortly.
Yeah, can't wait. Good to see you too.
Thanks for listening to the Make Rich Real podcast, where $1 million businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Do Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.